Hi, Peter Jones, Chartered Surveyor, author and property investor, and in this video number 10 of our short series of 12 videos, we're thinking about exit strategies. Now you want to think about your exit strategy right from the very beginning, and I know that before you own even one property, you might be thinking, well, it's a bit premature to even be thinking about how I get out of the business when I've hardly got into the business, but it's worth thinking about from the very beginning. And I say that because if you try and change things down the line when you already own a few properties, it can get very messy and very expensive. So what are our potential exits? Well, I know a lot of investors who will tell you that their exit is essentially death, that they're going to buy properties, they're going to hold them, they're never going to sell them. And thinking back to an earlier video, probably we're going to be doing that through our limited company. But of course your limited company may be owned through a trust and all of that good stuff, so you need to think about that. So death is certainly an exit. If you're doing simple flips, then you're probably going to exit every time you buy a property because you're just going to sell it on. Maybe you're going to put together a property company, fill it full of properties, and then sell the company. Or maybe you're going to sell shares. You have the option of doing a partial disposal, sell some shares. Or you could sell the whole company, sell all the shares, for example. Or you could just sell the properties out of the company and then wind the company up and then take the cash out of the company. Obviously you need to discuss that with your accountant and plan for that, because there's all sorts of tax implications and admin implications which you'd need help with. So there's always going to be different things that we can do to exit. The key thing is that you start to think about that right from day one, because as I say, it can be very difficult. If you set it up in one particular way and then in 10 years time you wish you hadn't, it can be very, very difficult to change all that. So think about your exit strategy, think about what it is you want to achieve, and of course the two need to go hand in hand, and then you can have the proper structure for that. Thinking back to an earlier video, you may want to decide whether you're going to buy properties in your own name or in a limited company. 99% of the time, particularly if you're holding the properties, you're probably going to want to buy them in a limited company. And actually, having said that, if you're going to be flipping, you probably want to do that through a limited company as well, because if you do it in your own name, the profit from a flip will be charged at income tax. Now it sounds a bit strange because when you're flipping you'll be adding value, and so one imagines it would be capital gains and you'll be able to take advantage of your capital gains tax allowance, but not so. HMRC will very quickly say that if you're flipping regularly, it's actually trading income, and then they'll charge you income tax. If instead you flip through a company, then you'll be charged corporation tax. So there we are, a few ideas for you. Hope that helps. Here's to successful property investing.